Something is being sold off at a pace of trillions of dollars right now. At this very moment, while you are watching this video, there are no sirens, no red banners scrolling across the screen, no panic, no people lining up outside banks like in 2008. On the surface, everything still looks fine. Markets are still open, television is still talking about inflation, interest rates, and elections. But beneath that surface, a massive shift is taking place, so quiet that if you do not know where to look, you will miss it completely. What is being sold was once considered absolutely safe, the foundation of the global financial system, the place money runs to whenever the world starts to shake. For decades, people believed holding it carried almost no risk at all, and that belief is the biggest dangerous thing of all. Because the biggest turning points in monetary history never begin with a crash, they begin with silence, with small numbers buried deep inside reports, with decisions that never need to be explained to the public. In less than 2 years, more than $1.3 trillion has left United States government bonds. Not because of panic, not because of rumors, but because of institutions that understand this system better than anyone else. Central banks, national reserve funds, the kind of players who do not act on emotion, but on structure. No one steps forward to warn you. No one says, pay attention, because when you truly understand what is happening, you do not need to make noise. You just leave early, and you leave quietly. This is not a prediction. It is not a doomsday scenario designed to scare you. This is a pattern that has repeated many times throughout history, under different names in different eras. Rome once believed their currency was eternal. The British Empire once believed the pound would rule the world forever. America once believed its bonds were risk-free. Each time, the belief lasted a very long time, until it didn't. If you watch this video to the end, you will not only understand what is being sold, but more importantly, you will realize where we stand within a historical cycle much bigger than any one of us. Not standing outside and observing it, but living right inside it. And by the time the majority begins to realize that something has changed, those who understood the pattern from the beginning have already left their positions long ago. For decades, the world was taught one simple rule. When everything becomes unstable, go to United States bonds. When wars break out, when markets collapse, when financial crises spread, money flows there. Not because of high returns, but because of safety. People called it risk-free, no risk at all, almost like a law of nature. But history shows that there is no such thing as absolute safety in money. There are only periods when risk has not yet revealed itself. And every system that collapses begins exactly where people once believed was the most secure. Look back at Rome. The denarius was once the commercial standard of the entire Mediterranean world. Soldiers were paid with it, taxes were collected with it. The empire functioned smoothly for centuries. No one questioned the value of that silver coin until spending exceeded capacity. Wars dragged on. The treasury slowly dried up, and the only solution left was to dilute the currency. At first, the change was very small, almost no one noticed, but once trust began to crack, it never returned to its original state. Or look at Britain after World War II. The British pound was once the center of the global financial system, reserves, settlements, power. But behind that prestige was a mountain of war debt, spending beyond its means, and promises that could not be kept. When countries began exchanging pounds for gold and United States dollars, Britain did not collapse overnight. They controlled the situation, they delayed, they devalued, and over more than 2 decades, the pound quietly slipped away from its dominant position. The common thread in all of these stories is not panic, it is a change in behavior by those who understand the system. No need to run, just a need to adjust positions. Today, United States government bonds are sitting in that exact place within the cycle, not because America is about to default tomorrow, but because the structure has changed. When debt grows faster than economic growth, when interest costs swell into a major budget burden, when the largest buyer is no longer foreign countries, but the central bank itself, then safety, no longer means what it used to mean. Those selling United States bonds today are not acting out of fear, they're acting out of math, because they understand that prolonged negative real yields are not an accident. They are a consequence, and when a consequence lasts long enough, behavior changes. This is the moment when the cycle begins to shift phases, not loudly, not with immediate collapse, but in a way that cannot be reversed. And in the next part, we will place all of these pieces into a clear historical framework so you can see exactly which stage we are in and why what comes next is not a surprise, but the next step in a pattern that has repeated many times before. When you step far enough away from the daily headlines, you start to notice something uncomfortable. Monetary history is not as chaotic as people think. It operates in cycles, repeating with a precision that is almost frightening, not because humans lack creativity, but because power, debt, and money always collide with the same limits. This cycle is not complicated. It has only a few stages, but each one leaves very clear marks. The first stage is always trust. A nation builds credibility. Its currency is tied to real production, to fiscal discipline, to military victories, or to a central role in global trade. Outsiders want to hold that currency because it represents real strength. This is the phase when money and value still move together. Then comes the expansion phase. The currency becomes the center. The world needs it for trade, for reserves, for settlement. The issuing nation gains privilege. It can borrow cheaply. It can spend more than its true capacity. It can export inflation outward. And for a long time, everything looks as if this system cannot fail. Next comes overload. Spending is no longer a choice, but a political obligation. Wars, social programs, bailouts, defending global influence. Debt grows faster than real growth. Money is created faster than real value. At first, no one objects, because the system still functions. But internally, the structure has already fallen out of sync. The following stage is always relative loss of trust. Not panic, not collapse, just the people who understand the math beginning to adjust. They do not need to sell everything. They simply buy less, diversify more, reduce dependence. Capital flows change direction very slowly, but once they turn, they do not reverse. The final stage is restructuring. The currency does not disappear overnight, but its role changes. Power is shared. A new system forms alongside the old, and those who continue to behave as if they are still living in the first stage are the ones who pay the highest price. Rome went through this entire cycle over several centuries. Their silver coin was gradually diluted until no one trusted it anymore. Trade returned to physical goods. Central authority dissolved. The empire did not fall because of a single battle, but because money stopped performing its function. The British Empire went through a similar cycle, just faster. The pound did not disappear, but it lost its central role. Global reserves moved away decade by decade. Financial power changed hands without any official declaration. The United States is not outside this rule, not because America is weak, but because no one is strong enough to escape mathematics. The cycle does not respond to flags, ideologies, or technology. It only responds to debt, capital flows, and trust. And when you look at what is happening today, not through emotion, but through this model, one thing becomes very clear. We are not at the beginning of the cycle, not in the middle. We're at the point where history always starts to accelerate. If you want to understand what is happening to United States bonds today, do not look at Washington. Do not look at the Federal Reserve. Look back to London about 100 years ago. Not because history repeats itself exactly, but because roles always repeat. And Britain's role back then is almost identical to America's role today. In the late 19th century and early 20th century, the British Empire was the financial center of the world. The pound sterling was the global reserve currency. Most international trade was settled in sterling. British government bonds were considered absolutely safe assets. London was where global capital flowed. If you lived at that time, no one questioned sterling. There was no alternative scenario. Britain did not need to export heavily to maintain a high standard of living. The entire system was built around reserve currency privilege. Colonies held sterling. Central banks bought British bonds. The British government could borrow at low interest rates, fund its navy, its wars, and its global administrative system without immediately feeling the cost. This is the most beautiful phase of every monetary empire, and it is also the most dangerous because it creates the illusion that the system is permanent. Then war arrived. Not one, but two. The First World War forced Britain to borrow on a scale massive. Gold began flowing out of the system. After the war, Britain tried to return to the gold standard, trying to preserve the old image in the old role. But the economy had changed. Production was no longer leading. The United States had overtaken it. The Second World War was the final blow. When the war ended, Britain was a military victor, but a financial loser. Enormous public debt, foreign currency reserves nearly exhausted. The system could no longer sustain its central role. But pay close attention to this key point. Sterling did not collapse overnight. There was no day when the pound died, no global chaos, just desperate efforts to extend a role that had already expired. In 1947, Britain was forced to allow sterling to become convertible. In a very short time, foreign exchange reserves were drained. A run on the currency, not driven by emotion, but by mathematics. The British government had to turn to the International Monetary Fund, a psychological shock for an empire that once lent money to the world. In 1949, the pound was devalued by 30%, not because markets hated Britain, but because there was no other option. Debt was growing faster than the economy, deficits were persistent, the reserve currency role was no longer being subsidized by the world. Even then, many people still believed this was only temporary. In 1967, the pound was devalued again. This time, there were no excuses left. It was an admission that sterling could not return to its former position. No official declaration was needed, no grand agreement. The world had simply moved on to a different center. Sterling did not disappear. People in Britain continued to use it, but it was no longer a global safe haven. British government bonds were no longer the benchmark. Long-term capital had gone elsewhere. And the most important question is this: who lost the most during this process? Not financial elites, not those who understood the cycle, but the British middle class. People who held their savings in sterling. People who bought government bonds believing that the state cannot default. People who believed because Britain once ruled the world, that position would last forever. They did not lose everything in a single night. They were worn down through inflation, through devaluations, through control capitals, through high taxes, through stagnant growth. A process that lasted for decades, slow enough to avoid panic, but steady enough to be impossible to reverse. And this is what you need to remember when looking at the United States today. Sterling did not lose its role because Britain was weak. It lost it because the cost of maintaining that role exceeded the benefits. When the world recognized a new center with less debt, more production, and stronger finances, capital shifted automatically. No vote was needed, no open currency war. The United States became that center after 1945. And now, the real question is not whether America will collapse like Britain did. The right question is this: which stage is the United States along the same path Britain once walked? If the story of the British Empire is about the slow decline of a global role, then Weimar Germany shows the other side of the same rule. What happens when a nation tries to delay reality with money? Not because they failed to understand the problem, but because they had no other political choice. In 1918, Germany emerged from World War I completely exhausted. Industry was damaged, the population was worn down, and then came the final blow. The Treaty of Versailles, 132 billion gold marks in reparations. Not paper money, not promises, but gold, foreign currency, and real goods. An obligation far beyond what the German economy at that time could realistically handle. The Weimar government faced three options: raise taxes aggressively, cut spending deeply, and accept a severe economic depression, default openly and accept the loss of international credibility, or print money to buy time. They chose the third option, not because they were foolish, but because it was the only path that allowed them to survive a few more years. At first, everything looked manageable. The mark weakened, but the economy still functioned. Debt was repaid with cheaper money. Unemployment did not explode immediately. Politics remained temporarily stable. This is the most dangerous phase of any monetary cycle, when the wrong solution still appears to work. Then the pace began to accelerate, not in a straight line, but exponentially. Once a government chooses to print money, it cannot stop. Each new round of printing is used to patch the damage caused by the previous one. The currency loses value faster, prices rise more quickly, tax revenues fall behind, and the response is always the same: print more. By 1922, one United States dollar could be exchanged for hundreds of marks. In 1923, millions, then billions. Not because German citizens suddenly panicked, but because the system had lost its anchor. When there is no limit to money creation, trust does not collapse because of emotion, but because of mathematics. Weimar is often remembered as a bizarre story: bread costing billions of marks, money burned for heat, wheelbarrows full of cash. But that was only the final chapter, when it was already too late. What matters more are the years before, when many intelligent people believed that we are still in control. The elite did not hold cash. They moved into real assets: land, businesses, foreign currencies. They did not need to predict the exact day of collapse. They only needed to understand that once a government chooses money to solve a structural problem, the outcome is already set. The middle class was different. They held savings, they bought government bonds, they trusted fixed pensions, and they were wiped out. Not by an official default, but by the continuous erosion of purchasing power. Weimar did not collapse because of money printing. It collapsed because money printing became mandatory policy. If they stopped printing, the system would fail immediately. If they kept printing, the system would fail more slowly. And that period of slow failure is what destroyed society most deeply. In the end, in 1923, they were forced to stop. The Rentenmark was introduced, a new currency anchored to real assets, a reset of the system. But the cost was devastating. Social trust was destroyed, the middle class disappeared, and political extremism rose, not by accident, but as a direct consequence of a monetary cycle pushed to its limit. And this is the key point you need to keep in mind when looking at the present. Weimar is not a prophecy of hyperinflation for every highly indebted nation. It is a lesson about dynamics. When a system cannot cut spending, cannot raise taxes fast enough, and cannot openly default, money always becomes the final release valve, not because it is a good solution, but because it is the only solution left. Now, history aside for a moment, and look directly at the present, not through emotion, not through belief, but through structure. Because if you understand the structure correctly, you will see why the world does not need to panic in order to begin stepping away from United States government bonds. United States bonds were once the center of everything, the place money rushed to when wars broke out, when financial crises exploded, when the world lost its sense of direction. But that role did not exist because of morality. It existed because of mathematics. Because the United States had growth that outpaced its debt. Because interest rates were lower than the rate of economic expansion. Because the dollar was needed by the world more than America needed the world. That has changed. Not in a single year, not after one election, but over 2 decades. Debt has grown faster than growth. Deficits have become the default. New bonds are issued not to invest in the future, but to pay interest on the past. This is the boundary every monetary empire eventually reaches, sooner or later. And once you cross that boundary, the role of bonds changes. They stop being a safe asset. They become a tool for delay. The world does not need to declare a loss of confidence in the United States. It only needs to do something far simpler. Diversify, reduce exposure, buy less than before, reinvest less when bonds mature. Small, steady actions that draw little attention. But when they are carried out by central banks, national reserve funds, and institutions managing trillions of dollars, they create a shift that cannot be reversed. What matters is this. This is not a sell-off driven by fear. It is a repricing of a role. United States government bonds are not disappearing, but they are gradually being treated like any other asset, with risk, with limits, and with a cost. And this is only the first half of the story. When U.S. government bonds are no longer the default safe haven, the question is not whether they will be a crisis. The real question is where the capital will go, and more importantly, how the current system will respond when it is pushed into a corner. Global capital does not disappear, it simply changes direction. It looks for places with less risk, less dependence, and less manipulation. And this process does not happen through a sharp turn, it happens through thousands of small decisions, reducing reinvestment, extending maturities, changing settlement currencies, increasing assets that do not depend on someone else's debt. This is when the picture becomes clear. When demand for bonds weakens, yields are forced to rise to attract buyers. But every step higher in yields squeezes the issuer itself. Interest costs grow faster than economic growth. Deficits expand. New debt is issued not to build new capacity, but to keep the system standing for one more cycle. This is the negative feedback loop that every monetary empire encounters when its central role begins to slip away. The system has very few choices. Raise rates too aggressively, and the economy suffocates. Keep rates low, and the currency comes under pressure. Let markets adjust freely, and volatility spins out of control. Intervene, and trust erodes. There is no correct option, only options that hurt less in the short term. And because politics always favors the short term, the default response is to guarantee liquidity. Open the gates when markets are stressed, support prices when necessary, reassure with words, reassure with balance sheets, not because of conspiracy, but because not intervening means accepting a shock the system is not prepared to absorb. But this is exactly where another truth emerges. When intervention becomes habitual, markets begin to price in that intervention. Risk does not disappear, it changes location, from price volatility to trust volatility, from interest rates to currency, from markets to society. Capital understands this. That is why it does not flee all at once. It withdraws step by step. It spreads out. It avoids bottlenecks. It prioritizes flexibility over yield. And when enough large players do this at the same time, a new normal forms without anyone having to announce it. This is not a moment of collapse. It is a moment of rotation. In every historical cycle, the most dangerous phase is not when people panic, it is when most still believe that everything is fine while the structure has already changed. When the most important shifts happen in silence, when surface indicators remain reassuring, but the underlying flows have already turned. And this is the point to remember. When the safe haven role is questioned, the system is forced to pay to maintain it. Pay with higher interest rates. Pay with a weaker currency. Pay with greater volatility. Pay by accepting that dominance is no longer exclusive. There is no path back to the starting point, only a path forward with new constraints. If you are waiting for a formal announcement, you will not see one. If you are waiting for a crash, you may miss something more important. The reshaping is already being completed. If you ask, when will everything collapse? You are asking the wrong question. History does not run on schedules. It runs on position within a cycle, and position determines risk, not dates. In every major monetary cycle, there is a very specific moment, not when the bubble bursts, not when headlines start screaming, but when trust still exists while behavior has already changed, when people still say safe but no longer put all their weight behind it, when capital does not flee but quietly pulls back, when the system has not broken but is straining just to hold its shape. That is exactly where we are now. We are not at the beginning. The foundation has been eroded over decades. We are also not at the final stage where everything collapses into chaos. We are in the most dangerous transition phase, the stage where the old role still exists but no longer trusted absolutely. In this phase, history consistently punishes two types of people. The first are those who believe everything will return to normal. They wait for a familiar cycle, a soft landing, a technical fix. They forget that this is not a standard business cycle. This is a monetary, trust, and power cycle. it does not return to its starting point. The second are those who panic, chasing every headline and every short-term fluctuation. They see risk everywhere, but do not understand structure, so their actions lack direction. The people who make it through this phase of history share one common trait. They do not try to predict timing, they identify position. They understand that when a system enters a restructuring phase, the priority is no longer maximizing gains, but reducing dependence on assumptions that no longer hold. This is not a call to take specific action. It is a warning about perception. If you continue to view the world through assumptions from the previous phase, you will react too late. If you understand that the cycle has moved into a new phase, you do not need to rush. You simply need to avoid standing in the wrong place when the seismic shift finishes. History follows a brutal rule. What appears to change the slowest in the public eye often changes the fastest in reality. When a monetary system enters a phase of decline, it does not collapse immediately. It extends its lifespan. It adapts. It adjusts the surface. And this phase is precisely the one that causes the most damage to the majority, because everything still looks familiar, while the underlying reality has completely changed. What comes next is not a single event. It's a chain reaction. When the world buys fewer United States government bonds, the United States must offer higher interest rates to attract buyers. Higher interest rates inflate debt servicing costs. Larger debt costs force more borrowing. More borrowing requires markets to absorb more bond supply. And when markets cannot absorb enough, the central bank becomes the buyer of last resort. This is not speculation. This is a mechanism that played out in Britain, in the United States after 1971, and in every monetary empire when its reserve role begins to weaken. It does not require bad intentions. It does not require conspiracy. It operates purely on mathematics and politics. The outcome of this chain is not necessarily immediate collapse. More often, it is prolonged erosion. The currency does not lose value overnight, but it loses purchasing power year after year. Financial assets do not crash outright, but volatility grows more violent. People do not panic, but they feel that no matter how hard they work, they are not moving forward. This is how old monetary systems die, not with an explosion, but with the exhaustion of trust. And alongside that process, something else is always happening. A new system is forming in the shadows, not through grand announcements, not through the instant appearance of a replacement currency, but through small, repeated choices. Bilateral trade instead of centralized settlement, diversified reserves instead of concentration, payment systems designed to reduce dependence rather than maximize convenience. There is no transition day. There is only the moment when people look back and realize that the old order is no longer the center. History shows that the most dangerous period is not when the new system finally takes over. It is when the old system still holds power, but no longer commands absolute trust. At that point, every decision becomes defensive, every policy is reactive, and the cost of mistakes grows exponentially. If you are waiting for a clear signal to be certain, you will always arrive too late, because monetary systems do not send notifications before they rotate. They leave clues only for those who are trained to watch behavior, not words. The final part of this video will not focus on a specific scenario. It will focus on the mindset required to live inside a cycle that is changing phases. Not to predict every step correctly, but to avoid being pulled along by assumptions that belong to the past. Because history does not reward those who guess the timing right. It rewards those who are standing in the right position when everything changes.
There is a hard truth that history has never tried to hide. Every major monetary cycle ends in divergence, not fairness. When a system is still operating, but trust has already begun to withdraw, society does not collapse overnight. People keep going to work, keep spending, keep arguing about politics, keep believing that everything will eventually go back to normal. But beneath that surface, everyone's position has already shifted, often without them realizing it. Those who hold on to old assumptions, believing that what was once safe will always remain safe, are usually the ones who pay the highest price. Not because they are morally wrong, but because they are standing in the wrong place when the cycle changes phase. History does not ask whether you believe or not. It only tests whether you understand which stage you are living in. Romans did not lose everything in a single day. The British did not wake up one morning to find the pound worthless. Americans after 1971 did not panic immediately either. But year by year, decade by decade, the gap between those who understood the system and those who simply trusted it kept widening. And by the time the majority recognized the problem, the cost of adapting had already become too high. The most important takeaway from this video is not what will happen next. It is what is no longer true. The assumptions that once felt obvious, the beliefs repeated so long that no one bothered to question them anymore. A monetary cycle does not destroy everyone. It punishes passivity, not through violence, but through erosion. Not through a sudden crash, but through the feeling of why am I doing more, yet moving forward more slowly? If you have followed this video to this point, that already says something important about you. You are not looking for reassurance, you are looking for a map. And a map does not give you a single path. It shows you where the danger zones are and where the terrain has already changed. This is not financial advice. It is not a call for any specific action. It is a call to wake up your awareness in a phase where most people are still asleep inside old assumptions. If you want to continue understanding how these systems are built, why they always move toward the same outcomes, and more importantly, how not to become the one who pays the price for the transition, subscribe to this channel. In the next videos, I will go deeper into who designs the modern monetary system, the invisible mechanisms operating behind central banks, and the historical models that help you recognize change before it becomes a headline. History does not repeat because people are foolish. It repeats because people forget too quickly. The only question left is this: will you be the one who remembers early, or the one who understands only after the cycle has already closed?